2022. We're looking ahead to the September jobs report out on Friday. There's so much more that's going to happen between now and then. However, joining me now, ERShares CEO Joel Shulman. Joel, there's much to discuss, dissect this morning. What are you watching to start this new week, this new month, this new quarter?
Well, certainly we have the inversion in interest rates, which is about 40 basis points. You alluded to it earlier. This is a concern. I mean, we're clearly looking at 2, now possibly 3 negative quarters in a row. So sentiment's certainly very negative. We have a jobs report coming out this Friday. We also have October 13th, the new CPI numbers, which a lot of people are going to be watching very closely and see how the Fed responds.
Well, you mentioned the three negative quarters of growth, the first quarter, the second quarter contraction. But I will point out that the GDP now estimate from the Atlanta Fed is now at 2.4% growth. So that kind of ignores what will be happening in the quarters to come, because what the Federal Reserve is doing and plans to continue to do in terms of raising interest rates, Joel, that's going to take a year to 18 months to trickle out into the economy. So we're looking at a 2024 negative growth or weakness in the economy potentially.
Right. Well, I mean, again, as you point out, these things take a while to take effect. I mean, we didn't get into this mess overnight. We're certainly not going to get out of it overnight either. And with CPI, I mean, we've got to remember it's a lag. So particularly the housing, which is 30 to 40% of the total. And we've got to recognize that, the market's already down here. We're seeing energy down. We're seeing consumption and commodities down. We're seeing GDP down. We're seeing housing prices come to a complete halt. It was the worst case Shiller index since inception. So the indicators on the ground are already suggesting that we're inflation starting to come down. And with the Fed continuing to tighten, they have a very real chance of overcorrecting.
And Joel, that is unnerving to the point that it sends the message that central bankers, as if we already didn't know this, they have no clue what they're doing.
Well, UK is certainly being criticized from all angles in terms of the way they handle things with Brexit and now in the latest crisis. I mean, Europe's in trouble. I mean, they're going to have a much deeper recession than we're going to have here in the U.S. I think within the world, there are only a handful of pockets that, seem to be calm. India is one of those examples where they've actually received benefit through the war in Europe, where they're now receiving the oil from Russia and they're turning around and selling it to Europe at a profit. So their markets are fairly calm. But the rest of the world, including China, Europe, U.S., Latin America, we're all in trouble.
Before we go, something that we were talking about here last week. So bonds, the New York Times article, are having their worst year since 1926. And you look at the yield are falling this morning, but that means that the actual price is going up. That's good news. But in this environment where people just want safety, a yield of 4.2% on a 2-year, if you lock it in for 2 years, that looks pretty good if you think the Federal Reserve is going to be able to bring inflation down to potentially below that level.
Maybe. I'm not sure I'd go that far out on a Treasury, a 2-year. Maybe you go with 1 year or 6 month. I do think, however, the last couple of months this year, we're going to see I think the markets are going to be in equities will be relatively flat for the next few weeks, maybe down a little bit. But I think if we start seeing CPI numbers that are improving, and I think as people have confidence that the market is going to be forward-looking at to following years when inflation's coming down, I do believe that we may see a little a pop in the markets, from November and December. So I think there's a chance there. But I wouldn't go 2 years out in the Treasury. I might go 6 months at this point.
And there's one headline, though, in the Journal today. It says, after a punishing year for stocks, investors aren't betting on a post-midterm rally. But you say otherwise, right, Joel?
It may be. We may be, and I think the catalyst, if we have such a thing as a catalyst, it would be CPI numbers that are showing starting to come down. But again, those are lagging indicators, And again, we're going to continue to see corporations coming out with revisions and earnings going down and so forth. Ironically, when companies announce that they're laying off, stocks do rally. So they're going to be, good news, bad news, throughout the last quarter.
Joel, great to see you this morning. Joel Shulman. We'll see you again very soon.
Thank you.
Your morning mover, Tesla, down in pre-market trading. The EV maker, electric vehicle maker, missing delivery estimates for the third quarter despite hitting a new record of more than 340,000 vehicles delivered. CEO Elon Musk saying that the company is aiming for steadier deliveries. Tesla stock is down nearly 25% year to date. It's down 4% pre-market. Coming up, Democrats losing ground with a voting bloc they have always counted on. They thought these voters were a lock.